Afternoon, ladies and gents. Simon Brown here, doing today's webcast, looking at FX, currency, and then index trading, really going down to the basics of it. Some of you might think, hang, I know this stuff, fair enough. But we want to just really very much go back to the beginning, go back to the basics, make sure we understand there's some nuances with FX and index different to your normal sort of CFD or single stock future, or even just plain equity trading that we want to delve in. If you've got questions, drop them in as they come along. We'll take them as they arrive, or we can pick them up later in the presentation. This is, as I say, excuse me, a series we've been doing monthly. So we've got, 3 more to go, October, November, December, after this afternoon's webcast. The ones we've done so far this year are available for download under special announcements, webinar downloads. We've got some from last year, which are trading systems, gap, engulfing candles, and my 721 trading system. And this, of course, ties in with the face-to-face events in Durban, Johannesburg, and Cape Town. I am first week of October. I think it's 2 and 3, or maybe 3 and 4. I am in Durban and Cape Town doing some of those events, and then back again in November, and obviously repeatedly in Johannesburg. And the plan is that they all sort of fit together within each other, and these webcasts obviously available for download. We will record some face-to-face events and make them available as well. I'm going to start with this. I know most of you have probably heard it. Most of you think, well, yeah, of course. It's an important point. We are trading derivative products, whether we're doing FX or indices, CFDs, futures of any sort. And as such, you can lose more than you start with. In other words, you put 10,000 or 50 or 100,000 or 1,000, whatever, into your trading account. You can lose that money and still owe more money. That's an important point. And in part, this is a disclaimer, but in part, it's also a be cognizant of this fact. And I talk about it in my face-to-face class, that as a beginner trader, a newbie, and a newbie is probably anyone who has been trading less than 3 years, our purpose needs to be to not lose money. Forget about making money. That will come in time. First, sort of trade and manage to not lose. If you can get through your first year of trading and you haven't lost money, to my mind, you're winning. Absolutely. So have as your focus the desire to not lose. The winning will come, the profit will come. But first, let's get to the point where we're not losing money. And then, as is the game of PowerPoint these days, it crashes on me. Cool, so everything's back. So let's look at indices and FX. First important point is that we're not trading the traditional rands and cents that we are when we trade in equity. We buy a share at 10 Rand, it goes to 12. We've made 2 Rand, we've made 20%. If we were geared, we've made more, but we're trading rands and cents. Yeah, very much we're trading in terms of points, and that's an important distinction. We also can go long and short. Let's touch on that first. Long is to buy and profit from the upside. Short is to sell and profit from the downside. In other words, with the long, you don't have a position. You buy, it moves higher, you make a profit. Of course, if you buy and it moves lower, you lose money. The flip side of that is going short, where you don't have a position and you sell what you don't own, it falls and you make a profit because you buy at a lower point. Say you sold at 10, it falls to 8, you buy at 8. You sold, then you buy, you sell at 10, you buy at 8, you make the 2. So the point with a short position is that you will then have a negative position. And that's critically important. And we're trading points or pips. It's not rands or cents. You can see on the right there is a screen grab from the near-dated Aussie futures contract, where we're looking at points. So the bid and the ask is 49,679 and 49,688. What's important, that's not the price that we're going to be paying, but that's the price which we will reference our trade entry and ultimately when we get out our trade exit. In indexes, it's the value per point. FX, you're trading pips, which is down to the 4th decimal place. We'll touch on that in some detail in a moment, but it's the important distinction that what we pay ultimately is that margin. And we'll touch on the margin in a moment, but it's not that this is a 49,688,000 cents, which is 496 Rand. That's to reference to where you enter the position. That'll then also reference you when you exit the position, very importantly. I want to touch on volatility. Volatility ultimately is a risk aspect. And I've talked about this before, and I talk about it repeatedly because it's important. Mostly when we start trading, we jump in and we trade shares or we trade FX. And my view is that's not good for in either side for a bunch of reasons. We should start with indices. The reason is shares are high volatility. For shares to move 2-3% a day is easy, and truthfully, if we look at recent moves, springs to mind Aspen today, Rhodes Food Group down some 10%, MTN 2 weeks ago, Steinhoff last year. Massive single event risk where an announcement by a company or a set of results or whatever the case may be, and whether they're good, bad, or ugly is irrelevant. It's how the market responds that matters. And shares are hugely volatile to that. And if you're on the wrong side of Aspen and it opens 10% down, or Rhodes Food Group or MTN or whoever, and you are geared, you're in for a massive, massive loss. And it's very difficult to manage that. A number of people said to me, yeah, but you should have already been short on MTN and on Steinhoff. There was no good reason to be long. Well, fair enough. I'm happy to take that point of view, but trust me, at some point in your trading career, probably at many points in your trading career, you will, for one or another reason, be on the wrong side of the trade. And the worst example I've got is Edcon. When they were still listed, 2007, there's a takeover announcement, and if you were short of that share, it moved 40% against you in literally like seconds. Your loss geared 7 times is 280%. Indices are much less volatile. For an index, for our index to do a 2% move, that's 1,000 points. That's a big, chunky move, and happens very infrequently, very, very infrequently. And single events. So, the MTNs, the Steinhoffs, the Aspens, they happen. They're a bit of a drag on the index, but they're probably single-digit exposure to that index at best, single percent. If you've got the biggies, such as the Richmonts and the Nasdaq, sure, they're at around 10 and 20% respectively. But even a 10% fall in Nasdaq is only going to slice 2% off the index. 10% fall in Richmond is going to slice 1% off the index. 10% fall in MTN. I'm trying to run the math. I'm trying to remember what MTN's weighting was. I think it was 6%. So 10% on MTN is 0.6 of a move within the index. Your FX is then your absolute lowest in terms of those risk profiles. And I'm talking majors rather than any of the minors. I'll touch on that in a moment. But how often do we see major currencies, not ZAR and others, dollar, euro, yen? Some people put the Swiss franc in there, sterling, moving 2% across their various crosses? And the answer is very infrequently. So truthfully, as a trader, we should start with FX. The problem is with FX is you're trading with the real pros, zero-sum game. For me to make money, someone has to lose it. So I say to folks, start trading with an index. Start in the local market with the ORMI. I'll touch on more on that in a moment, and trade that as your primary. Learn with that. When you're making money with ORMI, you can trade more ORMIs. You can trade up to an Aussie. Then you can perhaps start bringing some FX into the equation. Shares, I don't trade shares. When I most recently did, which was my momentum portfolio, I wasn't trading gearing. It was ungeared positions. So much as we like margin, means more gearing, means more higher risk. Higher risk plus the risk of volatility means we've got higher risk squared. There's the video we did earlier in the year on margin, leverage, and exposure. The link is down at the bottom of the slide there. You can go and find that video, download it, and view it. Grab it from the special announcements on online share trading, and look at individual and overall portfolio exposure. Short version, you probably don't want to gear your portfolio more than 3 times. In other words, if you've got 30,000 Rand in there, you want your gearing to your exposure to hit around 90,000. Whereas with 30,000, you can probably gear 200,000-300,000 Rands worth. But that is insane risk. Rather keep it down. And basically you do that by not using all what the provider lets you. What your broker says, you can buy 10,000 of these. Well, don't. Buy 3,000. Keep the position smaller, keep the overall leverage smaller, keep cash for when things go against you for those margin calls. Margin is in essence your deposit. I said earlier that we are trading points in this environment and we're not trading good old-fashioned rands and cents. So that 49,000 odd that we were seeing on the Aussie futures, if you're taking a currency pair trade or something like that, yes, those are your reference points. But what's really mattering is that you're putting down a margin. And that margin is essentially deposit, and it's a percentage of your exposure. Now, let me quickly explain what I mean from that. Is let's say you're taking a position on Aussie, it's 10 Rand a point. I'll come to more on that in a second. But what it means is that 49,000 points at 10 Rand a point, it's 500,000 Rand, or just under 500,000 Rand of exposure. Your profit is then determined from that. And if that index goes to zero, which indices don't do, you've lost 500,000. You've paid your margin, but you need to then pony up more money. And if it moves 10% and it's therefore moved from 50 to 55,000, the value's moved from 500 to 550,000, you've made that 50,000 profit. 5,000 points, 10 Rand a point, 50,000 profit. The Aussie and OMI locally, suffix is set margin. If you're trading FX, your FX provider will be setting your margin requirements, typically as a percentage. Your Aussie and OMI margin is set as a Rand value. So let's delve into those indices. Locally, we've got two index futures that we can trade. These are futures contracts. They have expiries. We've got the OMI and the Aussie, and they track the top 40 index. So that's the index of the 40 largest stocks in our market, and they're essentially tracking that. Your two contracts are the Aussie, which is 10 Rand a point, and your OMI at 1 Rand a point. Drop that S. So you can see quite a difference between the two. Starting point would be with the OMI at 1 Rand a point. You can start with 10,000 Rand. You've got to lose 5,000 Rand, 5,000 points before you're out of money. But it's a nice training ground. Even a market crash might certainly ruin your day, but it's, and it might even hurt your trading account, but it's not going to send you spiraling into a world of pain that you can't recover from. You find them under instruments, index futures on the online share trading website. You can see down at the bottom that the December one is there, but not yet available for trade, because we're still trading the September contract. They're quarterly expiries. And what we basically got is the two. The OMI and the Aussie are the two that we can trade, and they are tracking our index. We've got international ones that we can trade via web trader. And more indices than you can imagine. The ones that I typically like is S&P 500. Problem with S&P 500 is time zones. I don't want to be trading at night. Maybe you do. It's a great contract to be trading. DAX, which is Frankfurt, Germany, great index to trade, same time zone as us. It's expensive at €50 a point, but you can often find other products that you can trade around it. For example, the CFD on an ETF for DAX 30. Same time zone, uncorrelated to our market. FTSE 100 used to have a very high correlation with top 40. That has faded because we used to have a lot of our larger stocks were in both indices. So Old Mutual, Bulletin, and others used to sit in the two indices and therefore a high correlation. That's no longer the case. The correlation has broken. So another really good one to trade. They're all expensive, which is why I say to folks, start your trading life with that OMI at 1 Rand per point, upgrade slowly to the 10 Rand contracts, and then at some point you can start looking at international indices to trade as well. Your cost to spread is your margins. So your spread on all these typically about 2 to 20 points depending on time of day. So 5 to 20 points depending on time of day and amount of transaction going through. Your cost for both Aussie and OMI is currently 12 Rand 50 plus VAT per contract. So call it 15 Rand. If you're trading in Aussie, 15 Rand is 1.5 points. So it's negligible. 1.5 points to buy, 1.5 points to sell. If you're trading OMI, it's 15 Rand, but remember it's a Rand a point. So it's 15 points to buy, 15 points to sell. Because they're futures contracts, they have expiry dates. Expiry is quarterly, third Thursday of every March, June, September, and December. And if my math is correct, we will be having, I think we've got a rollover happening this Thursday. It's the third Thursday in September. If you have a position and you're going into rollout, the default at online share trading is to roll your position at the previous close. In other words, on the Wednesday, they will roll you into the December contract. We're currently trading September. online share trading only offers near-dated contract. We're currently trading September, either Aussie or OMI, and on Wednesday night after close and before the open on Thursday, they will basically get rid of your Septembers and they will give you December contracts, and off you go. You will pay a fee, but you only pay a fee on one leg, so you pay R12.50 plus VAT once per contract that you hold for that role. If you want to be closed out, that's fine. You got to go and change the default setting within your account. Margin requirements, current margins is 53,100 for the Aussie and 5,310 for the OMI. And that's exactly 10 times different because one is a 10 Rand a point contract and one is a 1 Rand a point contract. 10 times difference in the points, 10 times different in the margin. The margins are fairly chunky, but also understand that your requirements are fairly chunky as well in terms of you've got 500,000 or 50,000 Rand exposure for either 53 or 5,300. And we'll come to an example. So let's say you're going long on the Aussie and you take a position at 50,424 points. One Aussie contract, 10 Rand a point. Your exposure is therefore 504,000 Rand. With your margin at 53,000, it means your gearing is actually just a little under 10 times is your gearing. I don't stress gearing when I'm looking at indices and FX. The point is what I'm doing is I'm trading the points, and that's what matters. Can I make 500, 1,000, 2,000, whatever points as the case may be? And over a period of time, 10 Rand a point, that adds up. But you entered at 54.24. If you then exit at 57.24, you would have made 300 points. 10 Rand a point, you would have made 3,000 Rand. You've made 3,000 Rand profit before costs, but costs is going to be, in this case, about $30. So you would have made 2,970. If you'd gone short at that position at 504.24, so if you'd gone long and then exited at 500.24, you would have lost 400 points. 10 Rand a point, you would have lost 4,000 Rand. So that profit or loss is number of points, which is referenced from where you entered and where you exited. Question coming through on the webcast is, if you'd gone short, well, if we take this position here and you'd shorted the Aussie at 424, at this point you've lost 300 points, so there would have been a 3,000 Rand loss. At this point you've made 400 points. You sold it at 50,424 and you bought it back. So at that point you sold, your position is -1. You buy it back at 500.24, so now you're -1 and you buy it back, so you're +1, you're at 0, you've got no position left, you've made 400 points, 10 Rand a point, you've made 4,000 Rand on the downside. It is the beauty of trading these products is that we can make money in either direction. Sideways market, difficult, that's what we've seen for much of this year, but certainly a rising or falling market, you can make cash. FX, same but different. Only trade the majors, which is dollar, yen, euro, sterling. Some folks will add Swiss franc into that. I don't. And the trick with the miners is that they're just too volatile. So you really want to be focusing on trading the majors. And we're talking here about spot FX. If you're doing the currency futures, you've got to be ZAR, you've got to back into ZAR, and that's fine then because they're at a much different gearing level. Your first currency is base currency, second currency is the quote currency. So if you're looking at Euro USD, which is Euro dollar, of course, and the price is 1.1100, trade on 100,000 currency units, because a contract is 100,000, you would need to pay 111,000 US dollars for that contract. Now, again, remember that we're actually trading margin here, so you don't pay the full 111,000, but that is the value of the contract. Whereas the earlier contract we were looking at was talking around a contract that had a value of 500,000. Here we've got 111,000, and that then takes us at current exchange rates to about 1.6 million. So the numbers get chunky, but there are many contracts. We'll touch on that in a moment. The value here is 10 currency per pip. Remember, we're working currencies down to that fourth decimal place, 1.1100. If that goes from 1.11 to 01, that 1 pip move is going to be some profit or loss if you were short in the position. So value is 10 currency per pip, which is fourth decimal, and that's where we got to that number on the previous screen. So standard contract is 100,000, and in essence, therefore, it's 10 US dollars per pip. A mini contract is 10,000. So in this example here, instead of being worth 111,000 US dollars, it would have been 11,100 US dollars, which is about 160,000 ZAR. So your mini contracts is $1 US per pip. Every pip move, fourth decimal, you're going to make or lose $1. You're going to make or lose $10 on the standard contract. Your margin's around 3%. It's paid on the value, so on that 111,000 or 11,100 gives you gearing of around 30 times. That's quite chunky. Two things: you can drop that gearing by keeping more cash, and you can also manage it by an overall portfolio. But also, currencies are a lot less volatile. A 1% move in a currency in a short period is a big deal. But again, keep those gearing levels lower, keep your capital requirements lower. Remember that video I showed you about margin, leverage, and gearing. As an example, so keeping with that euro dollar at 111, taking a standard contract, which is $10 a pip, margin is 3,000 and change. That's giving you a gearing of around 30 times. If it moves to 112, it's moved 100 pips. 100 pips at $10 each, you've made $1,000. If it moves to 110.50 and you've lost 50 pips at $10 each, you've lost $500. So very much similar to the indices in the sense that these are essentially, these are not, the currencies are spot, they're not futures traded, so there's no expiry on them. But in essence, that 111.00 is referenced as your entry point. Where does it go from there? And we're going down to that fourth decimal in order to determine profit and loss. So in closing, start small. I always say to folks, ORME is a great place to learn your way around trading. You can use Iris Viewpoint. You can be trading it in a 5-minute chart if you're looking. It's nice, it's simple. So start small, start slow. Use a demo account, use a paper trading account. Get to feel how the whole process works. Would you be making money? How's it going? Go dig out some of the systems. We showed the links at the beginning of the video around the different systems that there are to trade. Find your own swing trading. Maybe you're doing breakouts. Maybe you're doing trend. Whatever your time frames are, go and manage those and get those to a point. And once you're comfortable with process and you're comfortable with how this is working and the like, then you can start to step up and say, okay, this is starting to work for me. I'm making some paper money. Let's put 10,000 in real ZAR and start trading ORME. And it's a process. It's going to take some time to get there, but that's absolutely the point. Trading is a process to get time to get to that point where you can start risking real money. And although trading a demo account or paper trading is not the real McCoy, because there's no cash involved, what you do get is that you learn the processes, you learn the systems, you learn whether a 5-minute chart is viable. I struggle to try that again. I struggle to trade an hourly chart, and yet my job is to oftentimes be watching the market. Trading a 5 or even a 15-minute chart is seriously challenging. So, 4-hour on FX is a great time frame. Daily charts work as well. And manage your risk. And that's part of what you'll learn in the demo and paper trading. But always when you're trading, be managing risk, especially when you're trading derivative products, because losses can exceed deposits. I know we hear it all the time, and it's always like, yeah, we understand that. But you don't truly understand it until someone phones you and says, that money you gave us, it's gone, and we need more money. Ladies and gents, that's from me. Contact details for myself, contact details for Standard Online Share Trading, and a disclaimer right there. If you've got questions, pop them into the Q&A box. I've got one question popping up asking what I trade. So I trade Aussie futures. I'm getting into trading the DAX as well. I like it's uncorrelated. It backs into euros, so it earns me euro currency. And that's nice. And then I'll trade sterling euro again because it backs into euro, and therefore I'm earning in euros. Eric, what did we say? The pros and cons of trading futures versus CFDs. So, there are a couple of issues. So futures are exchange traded. CFDs are not, which means you take counterparty risk. FX as well, you take counterparty risk. In other words, if the broker you're trading with is not there tomorrow morning, who's going to manage, where's your money? There's no JSC to keep you safe. So make sure you understand your counterparty. CFDs are much cleaner pricing in that you trade at the underlying, whereas futures is literally a futures price, which is plus dividends, less interest, so more complicated pricing. They also expire. CFDs are non-expiry, and you get charged in essence, your interest component is charged to you on a daily basis. CFDs are also one CFD per share, whereas the futures, the single stock futures, are 100 shares per contract, which is fine if you're trading a cheap priced stock. But if you're trading NASPAS, 100 NASPAS is at 3,000 Rand, is 300,000. Your margin on that starts to really, really stack up. I'm broadly agnostic between the two, as long as your counterparty risk is managed. Don't go trade with a bucket shop. The bucket shops are they offer you bells and whistles, but then you try and get your money and you can't, or they go bust one day and they're just simply not there. Question: why don't I trade the E-mini? So E-mini is the S&P 500. So I love the E-mini. It's a great product to trade. I just don't like the time zones. I don't want to trade at night. Night is dinner and drink and relaxation and Netflix and stuff like that. So that's why I'm not trading E-mini. I have at times past, but it really messed up my life in terms of time zones and stuff like that. DAX I like because it's uncorrelated to us. DAX, they've got different issues driving that index and making it happen. Yeah, all the other videos are available. Log into online share trading under special announcements. Look for webinar downloads. They're all there. You can download them and view them at your leisure. Yes. No, sorry, question coming. Yes, so the different futures contracts are going to all broadly the same. If you're trading DAX, same concept. However, you might be trading a CFD on it, but more importantly is check expiry dates. And that's partly why I say to folks, go in and do that demo trading, go and do that paper trading, so you learn the nuances of when things happen and how it looks when they happen and all of that sort of thing. Cool. Ladies and gents, we'll park that there. We are bumping up against the time. Thanks very much for your time. We'll be back again, as I said, in October. If you're in Durban and Cape Town, I'll be in your part of the neck of the woods first week of October, and then Johannesburg last week of October, doing presentations for online share trading. If you're in any of the three cities, book them on the website. Come say hi. Cheers all. Have a great day further.